Welcome to the Wealth Wisdom, where money has history and knowledge becomes power.
Imagine this. You've been saving for years. Each paycheck, each careful investment, every dollar tucked away feels like security. You tell yourself, I'm preparing for the future. I'm building independence. But what if I told you that your savings aren't just sitting quietly in a bank account, that every dollar you've worked for is part of a vast, invisible financial machine, one designed to make certain people richer while leaving most savers powerless? You've been trained to think of banks, pensions, and retirement accounts as tools for safety. But behind the scenes, these systems are far from neutral. Your money doesn't just sit there. It's lent, leveraged, invested, and moved across global markets in ways you never see. And in the process, it fuels a machine you cannot control. This isn't fiction. It's history, mathematics, and policy all converging in a system that rewards capital over labor, influence over effort. By the end of this story, you'll see your own savings, the very money meant to secure your future, in an entirely new light. Before we dive into the mechanics, let's set the stage. Money is more than currency, it's influence. Control it, and you can shape markets, governments, even entire societies. Banks and financial institutions are the levers. Every deposit, every loan, every investment creates a chain reaction that most people don't realize. When you deposit money in a savings account, it doesn't just sit in a vault. Banks lend it out, invest it, and amplify its value for themselves and you. You earn a small fraction in interest, while the machine grows richer from your trust. This isn't a conspiracy, it's mathematics, policy, and human behavior combined. And it didn't start yesterday. The story of how savings became fuel for a global financial engine stretches back centuries. In the early days of banking, money was physical, gold, silver, coins you could hold. Wealth accumulation depended on possession of tangible assets. Yet even then, rulers and merchants realized a fundamental truth: controlling money was controlling power. Medieval bankers, like the Medici family in Florence, pioneered lending systems that allowed them to profit from other people's wealth. They lent money to kings, collected interest, and used the same capital repeatedly. In essence, one coin could be recycled multiple times, each transaction increasing influence and wealth, often at the expense of borrowers who bore the risk. By the 17th century, modern banking practices emerged. Fractional reserve banking, lending more money than the bank actually held in deposits, became a tool for growth. One depositor's savings could now fuel multiple loans, investments, and trades simultaneously. The math was simple. Leverage multiplies profit, and risk is spread across countless unsuspecting individuals. The machine was born, and ordinary savers, thinking their deposits were safe, became unwitting participants. The 19th and 20th centuries marked the rise of institutional power. Central banks, investment firms, and global markets formalized the system. Governments encouraged banking expansion, retirement accounts, and savings instruments, all while keeping citizens largely unaware of the machine at work behind the curtains. Take the U.S. Federal Reserve, established in 1913. Its purpose was stability. Yes, but it also centralized control over currency, credit, and interest rates. Every monetary policy decision, from quantitative easing to adjusting the federal funds rate, ripples across the economy, affecting assets, investments, and debt. Your savings, tucked away in a bank or retirement fund, became part of this network. Banks lend it to corporations, invest in global markets, or buy government bonds. Those actions fuel industries, inflate asset prices, and sometimes destabilize economies, all without your direct involvement. The elite understood a key principle: those who control capital control outcomes. Crises, recessions, and market swings were not just disasters. They were opportunities. With every boom and bust, wealth shifted upward. Ordinary savers felt the uncertainty, while insiders leveraged it for profit. History is full of moments when the machine's power is undeniable. Consider the 2008 financial crisis. Millions lost savings, homes, and jobs. But banks that had orchestrated the system, the same institutions using your deposits as leverage, received bailouts. They used government money to stabilize their positions, while ordinary people bore the consequences. Or take hyperinflation in countries like Zimbabwe. Savings evaporated overnight. The public faced starvation, unemployment, and chaos, while those with access to foreign currency or insider knowledge preserved wealth. The lesson: the system magnifies inequality in times of stress. Even in less extreme circumstances, the rules are skewed. Interest on savings is minuscule compared to inflation. Meanwhile, the machine, investments, bonds, derivatives, compounds returns at exponential rates. Over time, wealth concentrates, while the depositor's share barely keeps pace with the cost of living. The consequences of this invisible machine are deeply human. Ordinary savers feel trapped. They work hard, pay taxes, and save diligently, yet their purchasing power declines. Retirement dreams are postponed. Educational opportunities shrink. The promise of upward mobility feels out of reach. Consider these figures. In the U.S., average savings per household hover around $7,000, a fraction of what is needed for retirement security. Inflation-adjusted returns on savings accounts over the last 30 years often fail to keep pace with living costs. Meanwhile, global financial institutions manage trillions in assets, using similar funds from ordinary people to generate returns orders of magnitude higher than interest on a savings account. The math is stark. The more people save in traditional instruments, the more their money fuels a system that grows wealth elsewhere, not in their own pockets. Governments and policymakers have tried to mitigate these effects. Regulations on banking, deposit insurance, and caps on interest rates were introduced. Retirement accounts like 401(k)s were created to incentivize long-term savings. Yet the machine adapts. Financial instruments evolve faster than regulation. Hedge funds, derivatives, and global capital flows find loopholes. The tools designed to protect savers often benefit the institutions first. Even cryptocurrency and fintech, marketed as democratizing finance, operate within a broader system. Early adopters gain exponentially, while latecomers often absorb volatility or systemic risk. The machine is resilient, always evolving, and designed to prioritize those who understand it. Today, your savings are connected to a vast global network. Banks lend and invest deposits in complex financial instruments worldwide. Central banks manipulate liquidity, indirectly influencing asset prices. Corporations leverage retirement funds and pensions to fuel mergers, acquisitions, and stock buybacks. The result? Ordinary savers face stagnant returns, while those controlling capital see compounding wealth. The machine moves invisibly, quietly channeling funds from the many to the few. Consider the recent rise in housing prices. Mortgage-backed securities, fueled by depositor money, amplified demand in global markets. First-time buyers face record costs, while investors and large institutions benefit. Or think of the stock market. Pension funds, 401(k)s, and mutual funds all pool ordinary savings, which are then invested in equities and derivatives. When markets rise, the gains are distributed unevenly. When markets fall, losses are buffered by institutional strategies, sometimes using government support. The cycle repeats, a system designed to perpetuate itself. Key takeaways: your savings are powerful, but not neutral. They fuel a global financial machine beyond your control. Understanding this is the first step to financial awareness. Wealth compounds for those who control capital. Traditional savings alone rarely keep pace with the machine. Strategic knowledge, diversification, and asset allocation matter. Awareness creates opportunity. Recognizing how the system works allows individuals to protect their future, make informed decisions, and seek leverage within, or alongside, the machine. This is the story of your savings, not as security, but as fuel. Fuel for a system you participate in daily, often unknowingly. Understanding it doesn't just protect your money. It gives you the chance to navigate, adapt, and make choices that can keep you from being swallowed by the machine.